All right, guys, we're going to get the webinar started. Hopefully you can hear me okay. Jamie, you can hear me all right there?
Yep, I can.
Garth, yes, I can.
Fantastic. Okay, well, good morning. Thanks for joining us all around Australia for today's property webinar, our property market update and property tax tips for better cash flow. So great to have you with us. First time we're doing it on a Saturday due to the daylight saving. We only 8:30 here in Perth, and we know Eastern States are 11:30 already. So thank you for fitting us in. We will do our very best to give you some excellent value for your time. And I'm well supported today by my fellow presenters today. So I'd just like to introduce them briefly. So Jamie Horner from our rental expert, please say good day and tell us a little bit what's been happening in your last week.
Good morning, Garth. Welcome to everyone. I hope you've had your morning coffee. Look, Garth, it's been a hectic week. I think we've seen each other a few times. Lots of stimulus, lots of action. Recently had the Minister announce quite a few items in that property space. So looking forward to having a chat about it today.
No, fantastic. And thank you so much for joining us on your Saturday. Our other expert presenter today, Patrick Thatcher, property tax accountant expert. You've been a busy person this last week, Patrick. Are you back in Perth? And what you been up to?
Sure, I have. Well, I've just returned from Kalgoorlie. I have a practice in Kalgoorlie as well, so I operate both from Perth and Kalgoorlie. So you would call me a FIFO accountant, I'd say. But look, lots happening in the regional Australia, and the word on everybody's mouth is, how can I best manage my tax? How can I leverage off my tax to create assets and good value assets? And property is the buzzword at the moment. So yes, we hopefully can give your listeners some practical tips.
Now that's great, Patrick. And although you work between Perth and Kalgoorlie, you have clients Australia-wide. Is that correct?
Right across Australia, from Mackay, Queensland, all the way down to Sydney CBD. I've got one brand new client now from Melbourne. I've got a client in Tasmania, Kalgoorlie, Exmouth and Broome, and obviously Perth.
Yeah, no, that's fantastic. And we look forward to listening to your guys' tips and updates. So that's fantastic. All right, we're going to get the webinar on its way now. And hopefully my computer behaves and the operator knows what he's doing. So here we go. So just and I'll just get my presenters to mute themselves. That's fantastic. Thank you. Just a general disclaimer, the information is educational only today. It's not specific to anyone's particular needs or circumstances. So just general education today. Just a mission statement from Property Powerhouse. So what do? We provide education, support and experience. We enable mum and dad investors to buy quality properties all around Australia, enabling them to retire with multiple passive rental income streams, ensuring them a financially free lifestyle in retirement. So that's what we do at my business, Property Powerhouse. All right, so important steps to investing. So we're just going to do a little 101 in property investing, just so we get ourselves in the zone. Saturday morning, let's think about, investing. What are the important steps with that? Number one, education, just like what you guys are doing today. Thank you so much for joining us. This is really important. Today's webinar, there will be absolutely no selling going on. There's no selling of services, no selling of properties, strictly education. And you just cannot get enough education. The markets are changing all the time, so you need to keep updated. Educate yourself around property investing. Get a really good finance broker that you love and someone that you trust. Really understand your finance and your purchasing capacity. It all starts around that, and that's a moving beast. Banks are moving, the criteria, interest rates are moving. Then it's about selecting the right property, and it can be really confusing out there. And that's why that brings me to my next thing about building a team. It's very difficult to do it well and to do it right, property investing on your own. About 5% of people may be lucky, select their own property, maybe get their own loan, and do it on their own. But like most of you on here, you're an expert in your own industry, and you need to work. People may buy one investment property in their lifetime, or maybe a couple, but it's not something you do every day. So work with a team, a great team of property, finance, tax, property management. Get that great team around you. Try and get through. What you want is a nice, smooth settlement process. No hiccups, no fun and games. Just nice, simple process. Then you can get a nice, get a tenant in there as soon as possible. Get the rent coming in. The income is very, very important for being able to manage and hold the property. So having a good tenant that pays on time, that doesn't cause trouble, and just keeps the property ticking over. Using what we'll touch with Patrick a bit later is the depreciation schedules. How important that is, especially now with high interest rates. Understanding depreciation, the benefits, and being tax smart is really important about doing well and being able to help you with your cash flow. Long-term hold strategy, holding for 15 to 20 years. If you buy the right property and hold the property, you're going to do very well. All right, so property is not get rich quick scheme. You've got to look at this as a long-term investment. Therefore, you've got to buy well in the beginning, and it's important to buy the right properties that you can hold for that period of time. When that properties go up in value over a period of time, they may get really good equity in 3 years, 5 years, 10 years. But 15 to 20 years, you're going to do very well over that period. And when the property grows in value, that's what we call the equity. Look to have opportunity if it's within your strategy and you want to buy multiple properties and build a portfolio, well, you can use that capital growth to move forward. And we go back to the top of the list. The education is ongoing. It's not, I've learned about property and that's it. No, it's a set and forget. I never have to keep learning. You need to keep learning as the markets are changing. Stay in the forefront. Stay ahead of the pack and ahead of the game. Don't be chasing the game. Know what's going on. Right, my business, Property Powerhouse. So we've been in operation about 7 years now, and helping mum and dad investors to buy properties Australia-wide. Why would you use us? There we go. So point of difference with us is we Australia-wide, so we've got access to the best properties all over Australia, not just in one state. We help buyers through all the stages, so we don't just help them find the right property. We help them put a great team of people around them. We help them if they don't have a finance broker. We'll recommend a finance broker or multiple finance brokers. We'll be recommending a really good settlement lawyer to help with the contracts and help with the settlement of the property. We'll be recommending a good property manager, building inspectors, insurance people, depreciation. So we'll make sure that we'll help you through all those stages. We'll help get a really good understanding before we even start about what's your strategy. How sensitive are you to cash flow? Do you have a little bit of cash left at the end of each week or end of each month to help go towards the property? If so, how much? Because that will help us make sure we get the right property that you can buy and hold for that 15 to 20 year process. We'll help you throughout the whole purchasing stage of the property. We'll help you once the property is settled. A normal real estate agent would hand you the keys and say, there you guys go, good luck, phone me when you want to sell it. And we don't do that. We will hang around as long as you own that property. We will remain a support person for you, and all of that at no cost to you. So we offer a wonderful service. Our Google reviews will give you some insight into the experiences of our clients, and our business remains boutique by choice, so that we can offer and retain good service and good communication with our clients and all our partners. All at no cost to you. Yes, we do earn an income. I wish I was fully funded and I could just retire, but no, we've got to keep working through the business. How we get paid is by the vendor. So we get paid a marketing fee if a property settles, and if a property doesn't settle, we get paid nothing. So we got to make sure that you're doing all the right things throughout the process. Get the property to settlement. The property gets to settlement, that we paid a marketing fee. Comes out of the vendor's profits. And one thing that we're very proud of is all the properties we recommend will value on contract price, which means we negotiate well for the buyers. And if the property doesn't value up, then you don't need to proceed to settlement. We could put a line through that property and go to another property if there was any issues around valuation. So at the moment, we're doing a fantastic job with valuations. Our research team around the country are negotiating well, good properties at the right price, and rejecting a lot of properties that are not in the right areas and not priced well. So our research team doing a fantastic job with sourcing properties at a time when stock is really, really tight. Let's have a look. So that's a bit of the 101 investing, a bit about Property Powerhouse. Now let's have a look at the market, the property market Australia-wide. What's actually been happening? So at the end of each month, CoreLogic, see bottom right there, CoreLogic, they are an independent property analysis business. They record all residential sales data right across the country. They're independent. Their information is very reliable. You'll often hear CoreLogic being quoted in the media. And I love this graph that comes out, this table that comes out each end of, it actually comes out the first day of each month and it records to the last day of the previous month. So this came out literally on the 1st of November, and it was for all data at the end of 31 October. On the left-hand side, we've got the capital cities. The extreme right-hand side is the median values. And as we would expect to know, median prices in Melbourne and Sydney and Melbourne are the highest in the country. Now, this is across dwellings. So it's not just houses, it's apartments. So the apartment prices generally are cheaper. So that will pull down the overall dwelling price. If we were looking at homes only, Sydney would probably be closer to 2 mil or 2.5 mil. So these numbers are much higher if we looked at houses only, but they're across all dwelling types to give us a median. That's the middle price sale. If there were 1,000 sales in that month in that city, priced from the most expensive to the cheapest, where is the 500th sale in the middle? So it's not too skewed by averages and things. So median gives a much more realistic result. So why do we look at this table? Well, this table can tell us a pattern and behavior. What is the market doing? Let's have a look at the first chart here, which is the monthly changes during the month of October. Now, in a month, it's not always your best guide within a month, because we could have something that might have just jolted those figures for a month, but we get a much better outline over a quarter, an annual trend. What is trending across the country? What our research team and where we've been, highlighting, we've been in the right 3 cities. So Brisbane, Adelaide, and Perth are the 3 best investment destinations, and they have been for probably the last 6 to 9 months. And this data will tell you why. So in the last month, you would see that the standout performer is Perth, 1.6%, and that's in 1 month. That is massive growth within a month, followed by Brisbane, 1.4%, and then we had Adelaide at 1.3%. Let's have a look at the quarter. That's probably giving us a more true trend line of what's actually happening in the market. Again, we'll see these are the 3 standout cities. Again, Perth 4.6%, Adelaide 4.2%, and 3.8%. We have a look what's happened over the last year. Perth again, so Perth tops all 3, 10.8%. Sydney has had a good annual growth, but as we can see, probably tapering off. It's still growing, but at a declining rate now, and that's because of affordability. Just because of affordability, and the pricing is so high there that it's growing at a slower speed. It's starting to, the rate of growth is coming down, but Perth, followed by Brisbane over the year, and Adelaide. So those 3 cities is where we focus on, and they have the 3 best rental yields as well. So we'll go through and have a look at the next slides. Western Australian newspaper, this is Wednesday this week. East Coast Raiders and investors buying up sight unseen in some cases in Perth, and they're really driving our property market at the moment. Reason being, they're just seeing those really cheap price points, our excellent yields, rental yields, which we'll hear more from Jamie a bit later on. But the market is really good buying for people all around the country. And often it's people in your own backyard. You don't realize the opportunity. Some people in Perth think prices are coming down and should they wait? And we don't see that happening at all. Jamie would tell you, we were at a function last night, and she'll tell you a bit later what some of the property researchers are predicting. We're predicting, at least 20% growth in the next 3 years out of the Perth market. The commentator last night was predicting much higher than that. So, really good time for property. Very confident about property in this market. There's no supply, massive migration. So demand is massive. We have the strongest migration in Australia since the 1950s. Our stock levels are at all-time low. So we've got massive demand, no supply, So it's really pushing rents, it's pushing prices, and we'll have a look at that now. So we saw that table just now from CoreLogic. That was in a tabular form. I'm going to use some bar charts for, I like colors and I like bars also so it shows the same information, but a slightly different way. So in a month, again, this is from CoreLogic. As again, we said Perth was the standout. So the green we can see in the month, the standout, those three cities again, Perth, Brisbane, Adelaide, on a monthly basis are performing exceptionally well. Only one city, Darwin, had a negative. So right across the country, all property markets doing well, but some are doing better than others. Over the quarterly, those are the three we highlighted again, Perth, Adelaide, and Brisbane. See how they really stand out. Across the country, again, national 2.3. So nationally, we're on a good growth trend over a quarter. All capital cities are positive. So the property market's very undersupplied and very strong demand. Annual, again, those three cities we were talking about, Perth, Adelaide, and Brisbane performing well. As we mentioned, Sydney has done well, but there's a declining rate of growth across there. But nationally, 5.6%, well and truly performing exceptionally well in the current market. Let's dig down a little bit further. Now, we normally talk about quartiles, which is fours. This graph here from CoreLogic actually breaks them into three sections. So this sort of mustard color is the lower 25%. The pinkish color there is your middle 50%, and the orange color is your top 25. So in this case, we're going to talk about the three pillars or three sections. Now, the reason we wanted to show you again is these bar charts are telling you the rate of growth in this last 3 months. Again, we do know it's Perth, we know it's Adelaide, and we know it's Brisbane. But let's knuckle that down, Garth. Where is all this action? Where's the heat in the market? Is it happening in the expensive properties, in the middle range, or is it the bottom range? And across all three capital cities, you can see it's in this lower third. All right. Now, why is that? One, it's because of affordability, right? So we got first home buyers and renters that are saying, we can't afford these rents. We know rents, guys, across the country are just growing at all-time record rates. They can't get rentals. The rental yields are going, they're jumping really, really quickly as well. And what's happening there is that it's attracting investors, number one. So investors are going to that price point properties. And also what's happening is it's your first home buyers and your the renters that just can't find rents or can't afford the rents anymore and saying, bugger that, we're going to go and buy now. And maybe they're buying, your more affordable properties, maybe apartments. But that's a trend that's interesting because it's that bottom third that's really driving the market. I'm mindful of my time. I'm waffling on a little bit, so I'm going to get into trouble with Jamie. All right, so demand and supply. Okay, so normally it's like normal fundamentals with property. What drives prices is we need very strong demand, and we need very limited supply. We need a strong economy. We've got that strong economy. We set the demand. Well, we've got the highest immigration since the 1950s. We've probably got too much immigration, to be quite honest, because as you guys all know, we've got people coming in. We don't have places to house them. Where are these people going to rent? Where they're going to buy? We've really got this massive shortage. So there's probably too much immigration going on at the moment. But let's look at it from a property perspective. And we can see this is a supply, what's happened over the last 12 months. Now, there's a reason the Perth property market is outperforming the others. And we can see here is that the stock levels are almost 30%. Listing levels are 30% down from last year. So there's 30% less stock and more people coming in. So more people are fighting for less properties, therefore pushing up prices. Normal 101 economics, all right? And we can see again, Brisbane, lack of stock there. Again, Adelaide, lack of stock. Darwin, they have some lack of stock. It's a smaller capital city, very driven off gas with the gas up there. It's a smaller type of city. It's not bad for investment, but it's a lot more volatile. They have a lot of apartments in Darwin, which tends to skew a lot of their data. So I'm going to concentrate on our three main ones here, but you can see lack of stock, and most of the other capital cities, you can see they've got a positive supply of stock. And that's why, although they're growing, they're not growing at such a as well as Perth, Adelaide, and Brisbane. Rental yields, you're going to hear from Jamie a lot more about the Perth market, but rental yields are really important when you're selecting a property because they equal the cash flow on the property. And we'll discuss interest rates in a moment, but when interest rates are at the levels they're at the moment, which we haven't been used to, right? With these levels now, like, wow, interest rates are quite high, but they're actually sort of a long-term trend line. They're where they probably are on a normal 10-year average, but these are the yields, and the better the yield, the better, right? Let's have a look at Perth. So it says 4.7. My researchers, the properties we'll recommend, will get you 5.5 or 6% in Perth through Property Powerhouse. In Brisbane, we'll be getting you 5%. I can get you 5%. Adelaide also around 5%. But again, you can see from an investor where are the best yields: Perth, Adelaide, and Brisbane. As I said to you again, Darwin's a little bit skewed. They got a lot of apartments versus the standalone Torrens title properties. So again, that's yields, and they're very important when selecting a property. Vacancy rates, you'll hear Jamie talking about Perth, but a normal cycle there, when the market has about 3% vacancy rate, a market is in equilibrium. You've just got many renters, people looking to rent, as you do have properties. So you've got a balanced market at 3%. We can look back at 13, 15. At those stages, rents would have been dropping. So this is across the country. So across the country in 2015, if you were a property investor, your rents were probably dropping. All right, that's probably where they were holding steady. Rents might be going up $5, $10 a week over that period. And then what's happened here is the rental supply has really diminished. Lots of expats coming back, maybe investors selling during the COVID times when they were putting rental caps on properties. Jamie will tell us if there was a trend, and maybe she can explain what's happened. But the reality is now we are way below the equilibrium, which means there's not enough stock. Vacancy rates are at critically low levels. I mean, this is a crisis level lack of stock. Great for a property investor, terrible for tenants, and we feel for them. And until we get back to around that 3%, the rents will keep going. So that's if you're in government and you're looking at that graph, that's a very worrying sign to see, and it doesn't fix itself overnight as well. Annual change in rents, again, green is Perth. You can see this is for houses, and you can see Perth outperforming all the markets. So most of the trend lines up, Hobart and Canberra coming down, but the rest of the country, trend lines are going up for annual rents going up. Interest rates. I thought this would be good to take it over a period of time. I think that's, Jamie, you're quite good with numbers. I think it's a 15-year period. So what we sort of see in the moment, we kind of just see this bit, you know, where we know we've all felt there's been 13 interest rate hikes over the last 18 months, and the most current one on Melbourne Cup Day. Little sneaky guys snuck that in 30 minutes before the Melbourne Cup. But sitting at 4.35, that is the cash rate. So what we sort of felt, we felt this big change in the short period. But if you look at a sort of general trend line, we're at probably long-term medium interest rates now. So we're at the long-term, this is the normal interest rates, and they're probably going to hover around here for a while. So we have to get used to it. We've got to adapt. We've got to adjust. This is going to be where the new interest rates will be sitting for a period of time. We may get some decreases at the end of next year, but we have to adjust to this. We need to select the right properties. We need to talk to Patrick and make sure we're getting as tax efficient as possible. But you could see 2007 interest rates that was Reserve Bank rates, so cash rates. So interest rates were probably around, you go to the bank, it's probably 9.5%. I remember having some loans with Westpac now about 9.25. I know if there's some older, more mature people on here, I know, maybe 25, 30 years ago, they had interest rates at 17%. I wasn't in Australia at that time, but so we've had some very high interest rates over the past. But as you could see, this last sort of 15 years, we've been in a declining interest rate environment, and now we've had this big jump. Current interest rates, so this is information courtesy of Mark Kruger from House and Home Loans. So typical investor loan, 80% loan to value ratio, interest only. A variable rate, we can get about 6.75. The fixed rates, not very attractive. So, again, I can't advise you on whether you should fix rates or not. That would be your broker having that discussion one-on-one. But there's nothing really sexy about these fixed rates. If they were around, they had a 5 in front of them, you may consider that. But it looks like the banks are factoring that these rates will be here for a while. So have a really good chat to your finance broker to understand, are you getting the best rates? Have a really good look of what your current loans are set up, and can they make them run more efficiently than that. So yeah, that's the market update from me. I hope there's been some information there. There is opportunity for questions and answers. If you have a look, there should be a bar either at the top or the bottom for Q&A. If you've got any questions, please type them in just before I move to the next presenter. So if there's no questions, we'll also be doing questions at the end. But if there's no questions for me at the moment, I'm going to hand you over to our next presenter, who is Jamie Horner. So Jamie, I'd like to introduce you. Jamie is a director at Empire Property Management. Jamie says, how do you become a long-term successful investor? That is really for a life of relaxation. How do you do that? And it's all about the team. Jamie has helped more than 1,500 owners for more than 20 years acquire, build, and hold their own property empire through investor-focused property and strata management strategies. Jamie has a master's in property, a Bachelor of Commerce, and a diploma in management real estate. And Jamie holds a wealth of knowledge and manages the Real Estate Institute of WA, REIWA, Property Management Team of the Year. So her team is an award-winning team. Jamie, welcome, and over to you.
Good morning, Garth. I'm going to get straight into it. This is beautiful Perth, and I must admit today it does look like it does on the picture. No airbrushing required there. Okay, so I can give Patrick lots of time because I think we all love the time that we can get for our tax tips. This is the Perth market rent and median days to rent. Now, I must admit, I use REIWA stats and they're always about 3 months behind. So when you see September 2023, it's because normally property is pretty fine to move by the quarter and assess it by the quarter. However, at the moment, probably across Australia, it's almost something that we need to be assessing monthly. So when you actually look at Perth, and look, I must admit, I have a lot of owners that between 2014 and 2018 very much know that market. But when you look what happened in 2019, that was when we probably should have experienced what happened in 2020. So COVID hit and we had a legislation that said that we couldn't actually amend the rents. So you'll see that when 2020 hit is when we got the impact of 2019, 2020, and from there, we just haven't been able to recover. So you'll see that one of them is apartment rents and one of them is house rents. So it's extremely important in my mind when you look in WA, you separate apartments and houses, with houses always probably performing a lot better, or something that's got land. So we're talking about villas and townhouses here. That's the prime product that we're looking for. Where are we going to see that dial? It can only go up. So Garth, I'll get you into the next one. Median days almost doesn't matter. You know, we list a property and it's gone. So let's have a look at the stats. And what I would like everyone to have a look at that is look at available rentals. 13,000 is a 7.2% vacancy rate. That's not a nice one. A really lovely vacancy rate is about 3%, which is what we had in 2019. And that's what we call a non-overheated market. You get 5 to 6 people come to a home open, you get a couple of applications, and rents tend to rise $10 to $20. And it's a more median kind of market. From there, you can see though, 2020, we just plunged considerably, and now we're down to a number. If you have a look, we have sustained for the last year about 1,800, 1,700 rentals. I'm going to get you to keep that figure in mind. And we've now hit a new number, $600 for our medium rent for house and $550 for medium rent. For those of you that live in WA, you go, oh, but you've got to understand how affordable that is. You know, you're looking at a very similar property in one of the key states and probably paying $1,400, $1,500. I don't work in Brisbane, but we tend to mirror the Brisbane market very similarly. What Perth and Brisbane do is a bit of a mirror market. I know when we do these presentations, Garth, I know that we tend to have someone from Brisbane and we could almost copy our slides. It's very similar. So next one over. So what numbers do we need? I always have believed that we needed 12 to 13,000 to get this back to equilibrium. We did have a session with John Kerry, the Minister, on Thursday, and his office has recently looked into those stats because he is the Minister of Housing, and we're now looking at 22,000. So my conservative figure of 12 to 13,000 houses has now been looked at, and it is 22,000 that we currently need in WA to try to get back to equilibrium in any way. I don't tend to touch on the sales market, but you can't look at one market without looking at the other. So you have, at a peak of about 13,000 rentals, you went down to 1,800, and we sit at 1,800. Now let's look at sales. Have a look at that line. So we've also peaked at anywhere from about having, again, 13,000 listings on the market, all the way down to having 4,000. So let's add that together. About 4,000 sales properties in WA and 1,800 rentals. Rounded up, let's say a lovely 6,000 properties available for sale or rent in WA. At the moment, because about 1,000 properties are bought a week and about 1,000 properties are rented, we have about 3 to 4 weeks of stock only available before it clears out again. Okay, Garth, next slide. Garth did ask me regularly, Jamie, have you got that picture wrong? And as a lover of economics, that is the best way I can describe Perth. Supply is unfortunately going down. We're not picking up on it, and demand is going up. So you saw the rent stats and you saw the sales stats, but supply-wise, we are at our absolute lowest in 43 years of building approvals. So it's not like supply is going up. The Minister is cranking every lever to crank up housing, but I'll give you an example. We talked to him about the fact that a Western Power installation takes 12 to 18 months. So if we can't even get power to our sites, how are we going to build them? So supply is diminishing still. And a great one that I actually only just took from this week, if you look at the bottom left, we are the fastest growing state. It is the first time in WA's history that we have a net positive state migration. That's people coming from other states, and a net state international migration. First time ever in WA, and it's not slowing down. The Minister did confirm we are averaging 1,600 new people into Perth every week. So if we look at those ABS stats that have been quoted, WA's not done this since 1981, and it's not slowing down. So if you're thinking to yourself, how can we have 6,000 properties in total, and yet 1,500 people coming per week and our supply is dwindling? That is why Perth will continue to grow at 1% a month. We will not be able to fill this supply figure for at least 3 to 4 years. You know, it's probably going to take Western Power 12 months to even to meet the backload of the last 2 years. So again, Garth talked about the fact maybe we should reduce population growth, look at easing those numbers, but we can't stop interstate migration. The wages are good here, and if I can go rent a property in Sydney at 1,200 per week, nothing, $600 is amazing in Perth. Internationally, we are about to also get another huge student wave in February coming up. So during COVID, we lost a lot of our students. We have a massive Asian market for international students for our universities. All of our campuses are at a peak, and we will actually get another wave coming in February. Okay, next slide, Garth. Gosh, I got a lot to get in. Okay, the number of rentals have actually also fallen. So Bond Administrator, part of Demers tracks, and we've lost 19,500 properties from the market. So these are people selling They're thinking it's a great time to sell because prices look so great. You know, they bought these houses, like Garth said, 15 to 20 years ago at 300,000. So they are like, wow. But just to let you know, we actually haven't got there yet. So even I have property and I probably hold too much in that asset class. It's not the time yet. I'm still expecting to see another 10% growth in my portfolio and another 30% over the next 3 years. And those properties that are selling out, they're going to first home buyers. That's a heated market. It's also going to eastern states. So they are looking at our medium house price and going, wow, like, you know, I'd pick this up. This is fantastic. We will face a shortfall of 25,200 new properties from 2023 to 2027. And there's nothing, even if we hit every lever, we still can't get that in. I wrote this noting we are the most affordable state. I think as of about 2 weeks ago, we are 0.1% off on being the most affordable state. One small state has pipped us, but we still remain very reasonable. And that picture is why. That is our lifestyle. It is beach, it is sun, it is sand, and we are that link point to all those places that you're talking about in Asia. We have an extreme labor shortage, so people want to come over and work here. You know, our mining industry is throwing really fantastic money at people to come here. We need the engineers, we need the builders, we need to construct. So it's the first time in WA's history that we actually have 1.5 jobs for every unemployed person. We not only could actually take every unemployed person, we have another 50% of jobs available unmet. Again, 1,500 visa approvals, and that is 46,000 persons per annum. I think the minister confirmed recently on Monday. To date, we're 44,000 already for this year. Again, I just said this, WA building approvals at a historic low because our builders cannot get all the levers in place to get the land up, like Western Power, or the staff, or the materials. Okay, it's sort of the perfect storm, unfortunately. Okay, Garth, I know you're going to touch on these, but I wanted to give everyone some really quick real-life examples. And when I say really quick, let's have a look at Rivervale. Now, again, you're probably wondering, wow, $745,000 for an investment, that's a lot. But you know what? The heat is not in that part of the market. So it was a great pickup. I know from this owner, he paid $745,000. He did his contract in December 2022, and we settled in July 2023. I'm not going to touch too much on this because I know that the owner on bank valuation, before these titles were released, he made $100,000. The bank value came in at $845,000. He built $100,000 equity without even owning the property. We rented at $900 per week, and it's 6.28%. For those that know Perth, Rivervale is amazing. We're talking, you know, it says 8Ks from the CBD, but it's probably, if you actually wanted to just ride your bike over the bridge, it would be 2Ks. Nollamara, definitely different. North of Perth, we got to rent this only in September 2023, 3x2, and again, built by an amazing builder. So thank you, Garth. When you walk through this property, it does not feel like an investment property. The owner has put ceiling fans in, which I know sounds odd. The ceilings are high, the rooms are big, there's lots of storage. The owner even just put an EV charger in. I mean, we're talking not the actual EV charger, just the power point. And someone looked at this property and we asked $650 per week and it rented at $700 per week. And I'm talking quality tenants. We're only choosing quality tenants on a $505,000 purchase price. So by the time this owner settled, he had $45,000 equity in the property and now has a rental yield of 7.2% with a 6-month rent review also coming into effect. Okay, last two, Garth. I know you're going to probably touch on some of these. Beckenham. There were 3 sets in Beckenham, and can I tell you something? People love, when they come to WA, don't get me wrong, some of them love apartments and our overseas people love apartments, but most people want a bit of land and a bit of backyard. So these were perfect. These Beckenham ones were 3 villas. 2 of them were 3 bedrooms. Some of them were 4 bedrooms, 12Ks from the CBD. Anyone that knows this area, you are next to the biggest Westfield in, I think, probably close in Australia. It's one of the biggest, Carousel. It has everything. Again, purchase prices ranged because of the 3 and 4 bedroom. We actually went on the market in these in September, asking anywhere from 560 to 610, and they were leased at 560, 610, 650. If you're wondering about that bigger price, it was because that 4-bedroom really made the difference. Again, we're talking more than 16 applications on these properties. This is the newbie, Garth. South Guildford, it only hit the market this week. It's a 3x2, and again, you're thinking, wow, South Guildford, it is just this picturesque property area. I actually have a picture of all the properties on the right, and the South Guildford one is an image of the house in the middle. But if you look at the bottom, that is what that estate looks like. This house is around these beautiful manicured parks, 13.8 k's from the CBD. And you've got to say, if you live in any other state, 13.8 is gold. Like, it's amazing. 639,000 purchase price. We advertised at 670 per week, and we have current applications from Thursday's home open at 700. And I must admit, Garth, another one has actually come in above 700. So we're going to be assessing these, and this one will be leased with a tenant moving in next week. Only advertised this week as well. So they're just some real life examples. And what you can see here is that these are north, east, south. But what they do, where they are, is in areas where land is limited, where you can't just have this massive subdivision built next door. They're landlocked, which means that the land equity is growing. That's why by the time these owners purchased it, Garth, and they settled, the bank val was much higher, because every single month we are looking at a 1% increase. So you delay 1 month, Garth, it is worth 1% more. So for that owner in Rivervale, he contracted in December, he settled in July, it was therefore worth 100,000 more. That's what we're looking at, 1% per month. Okay, Garth. Wow. I got that out as quickly as I could. Any questions, please put them in the chat box. But Garth, I think we better get to Patrick, because this is what we all want to know about. We want all that valuable tax time information.
Jamie, I appreciate that. And I'll just sort of reinforce there, those property examples that you presented there were all sourced through Property Powerhouse and for Property Powerhouse clients. So Jamie is a very important partner, third party at full arm's length, nothing to do with our business, but we've worked with Jamie and her team for 15 to 20 years. They are fantastic. They really do their due diligence up front. When I phone my clients every 3 months after they've settled, say, how are things going with your property manager, they rave about Jamie and her team. So Jamie, thanks. Your information is wonderful, and you always make us look so bad because your slides look so professional, and mine are always so basic. So I'm glad we got someone professional for slides. Right, we're going to move on now, and we're going to go to Patrick, and I would like to introduce Patrick. So Patrick Thatcher is the director of Thatcher Consulting. Patrick is an experienced business and specialist taxation advisor focusing on small SME, small business market, particular private clients and high net worth groups. His 20 plus years of experience in the industry, both as a business owner and senior tax advisor, has shown the passion he has for assisting his clients to grow and to maximize their wealth. Patrick works with clients Australia-wide, and again, I've worked with Patrick for over 20 years. He's fantastic. He is one of the best and most knowledgeable investment property tax accountants. As you'll hear when he talks now, not only is he knowledgeable, you'll be able to hear that he's just got a great personality. He's been very patient with me as a client over the years, patient with my clients. We all think, oh, tax, it's all nerve-wracking time, but he demystifies it. And just his own experiences through being a property investor. He's a property investor himself. He's seen the good. He's seen clients do it the right way, the wrong way. So I think he's fantastic. Welcome, Patrick.
Thank you, Garth. I have no words. You've said it all. Thank you for the great wrap. But before I jump into the tax realm of things, I just wanted to pick up on something that you both yourself and Jamie spoke about, and that's the migration rate inside WA, which is really driving our property economy at the moment. And we all know WA is highlighted by mining activities. It's the mining resource capital of Australia. This is where all the action happens up in the northwest, in the goldfields, in the Pilbara, in the Kimberleys. We have an enormous amount of mining resource stock that this country pretty much feeds on, and our skilled labour is in shortage right now. So this is why there's a migration of skilled labour from the eastern states, from overseas. They're coming from all over the place into WA to work on those big projects. And just to highlight the heat in this market, last week, as you mentioned before, I was in Kalgoorlie. I assisted one of the main business symposium, an annual get-together of all mining resources and business operators in Kalgoorlie. And we were told that there's $860 million worth of new projects, not existing projects. This is new projects that's coming on board. And they are sourcing expression of interest from big contractors, earth moving, construction, engineering, geologists, and all the rest of it. And WA does not have the capacity to produce the skilled labour required to work with those projects. So if there was ever a question on why are we getting so many new people entering WA, there's your answer.
So that's fantastic. Thanks, mate.
Yeah,
Thanks.
yeah.
So mate, that's good, and it's really good that you've just come. You've come back from Kalgoorlie fresh and giving us that angle from the coalface on the resources. And we obviously coming across a lot of clients that are on some good incomes, paying a lot of tax and needing some good tax advice. And property may be one of the solutions for that. What we were keen to talk through is some real live examples. So we've just seen this picture of this property in Rivervale. We're going to use this as an example. So what we do is we help our clients through the whole process. Once the property is settled and tenanted, we go and help them get a depreciation schedule, which we're going to have a look at a bit of a draft in a moment. And what is a depreciation, and what does it show you, and why is it helpful, Patrick? So this property we've known as an example performed exceptionally well for Capital Grove. The rental yields are fantastic. For anyone in Sydney or Melbourne looking at these, your eyes will probably be popping out because you're on 3.5%, maybe 4% if you're lucky. But the beautiful thing about buying new properties, which is what Property Pass recommends, is the tax depreciation. Tax depreciation. Why is that important? Tax depreciation equals tax savings, which equals cash flow. And I talk about the simple things, but it comes to Patrick. Now, this property here has a massive depreciation over its life of $378,000 to depreciate, and in year one, $16,935. So I'm going to go to the next slide if she behaves. This is, you can see BMT tax depreciation, they're depreciation people. So they do this report. I'm going to see if I can go to the next page. Goes for 40 years, the report, and that is produced. It's a one-off thing, and we give it to Patrick, and then it also has a breakdown like this. So Patrick, what does this mean? Why does depreciation work well for new properties and for tax deductions?
Well, two main reasons. Depreciation is, as defined by the legislation, it's the write-off of the asset value over its life. So it's split into two different areas. So you've got the building write-offs, which is your building costs, your infrastructure, your electrical, sort of components. All of that is in the price of the build. And the government allows a depreciation of what used to be 2.5%, but that's now increasing up to 4%, depending on the age of the property. And the newer the property, the bigger the deduction up front. We recommend clients to use the diminishing value method, which means that you get the bigger deduction in the early years of the property, and that sort of reduces year on year, but it still gives you some pretty significant deductions going forward. And why does that help? Well, if we all know about negative gearing, pretty much you're leveraging off the expenses that is generated by the property to offset your other income, to offset the tax off your other income. So depreciation being a big part of that provides you with a pretty big deduction to start with. Now, depreciation goes over a 40-year period. And the beauty with this is if you decide to sell after 5 or 10 years, you can actually sell the property with this report. And the next person that comes on board can actually rely on those figures to claim in their tax deduction. This is approved by the ATO, by the way. Accountants supposedly are not qualified to prepare a depreciation report unless it's been prepared by a quantity surveyor. It's pretty much stated in the legislation that the ATO will accept a quantity surveyor report, but will not accept an accountant's calculation of a depreciation.
Just a quick question. Yeah, Patrick. So so in the report, this is what you were talking about, the diminishing value. Correct. What is the other option, mate?
So prime cost method. So prime cost method is a different way of valuing the write-off of your assets. So it's more spread evenly across the ownership years. The reason why we say diminishing value is the better opportunity, because in the early years of the property, this is where you need the most assistance. This is where your cash flow is very tight. And if it's your first property, it's very hard to understand what it's going to cost you on an annual basis. So you want to make sure that most of the cash is returned back to you through tax deductions in its early years.
That's fantastic. And in case any of you are wondering this first year why it's less, it's because it's done prorated for the year of ownership. So this client in Rivervale settled on the 18th of July. So he doesn't get the full benefit. He gets the prorated amount, but that is the first full year. And you can see that's a massive deduction versus that's taking the account of your plant and equipment, and then it sort of stabilizes. But it will keep moving. So that was a property valued at, priced at $745, some excellent depreciation. Let's have a look at a different type of property now. Let's have a look at a cheaper property. These are the ones in Nollamara that we were talking about. Not only were they a very keen price point to get into, 9Ks from the CBD. Look at the rental yield. Absolutely fantastic. Being brand new, we get excellent depreciation again. So we're going to have a look at that. Remember the more expensive one, we got a 16K tax deduction. This one we've got 12. And again, so the same report, Patrick, same system?
Same system. And again, this one shows that because the property was purchased in April 2023, so they only have a few months of depreciation in that year. But, resuming to the full 12 months deduction claim right the way through. One thing that I do need to add, and it wouldn't be right to say that depreciation. I suppose depreciation helps the property owner whilst they own the property and the property is rented. But the moment that the property owner sells the property, and we know that property investing is long term. But what you need to know is that whilst the government is giving those deductions to investors, when you do sell the property, there is an add back calculation that needs to be considered. So whatever you've claimed in the ownership years whilst the property was being rented will be added back to your capital gain. So that's probably one other reason why you wouldn't be selling a property straight away. So you've really got to keep the property going and make the most of the tax deductions whilst you're renting the property, whilst you own the property, and because that's going to subsidise your holding costs.
I think you touched on something really good there, Patrick, and it's around getting the strategy right, getting the team around you. So talking to Patrick or someone like Patrick early on, even when you're buying your first investment property, work out a strategy. When am I buying? When am I going to sell this property? What's our exit strategy? And there'll be, Patrick, a right time to sell and a wrong time to sell as far as tax is concerned, right? There'll be strategic time. It's not just when the values are good. They have these tax implications when things get added back. And so really important to people to have a strategy with you, Patrick.
Absolutely. We meet with an average of maybe 3 or 4 clients a week at the moment that are asking for, retirement planning. And these are clients that aren't 60 and above. These are clients that are 40, 30, high 30s and early 40s that have got substantial income, and they've got, good jobs, very secured jobs, but they want to learn how to better utilize their cash flow so they can actually sink their money into an income producing asset to start with, but a growth asset at the start, at the end of it as well. What they're asking is not how many properties can I own, but what they're asking is how much is it going to cost me when I sell those properties? Well, we tell them, how long are you going to be working for? Do you have a retirement plan? If it's 20 years from now, well, then you don't really have to think about selling the property for another 20 years, because our strategy sits squarely on, you don't sell an asset if you don't have to until you retire. Because in retirement, your income is much lower. Any capital gains that you achieve at the time of sale, you won't have to add it on top of your salaries and wages, because this is where people lose a lot of money. If you sell your properties at the same time you are earning 200,000 or 300,000 a year, I would say 80% of your capital gains that you make on the property will go towards your tax.
Yeah. So what we're saying there is really have a strategy, and again, having this team of people around you. And if you're going to hold that property for 15 to 20 years, you've got to buy the right type of property that's not going to give you these headaches with repairs and maintenance.
One other thing, always have your end game in mind before you start your investing process. Know your timeline, know that your cash flow is supportive to start with, and that you're not going to have to offload your properties after 2 or 3 years. So very important to plan. We do a lot of personal budgets and cash flows for our clients, so they know what their initial commitment will be, and they factor that into their home and their home expenses, so they know that they can afford 1, 2 or 3 or 4 properties based on their borrowing capacity. But more importantly, when are they planning to offload? And when they do offload, what sort of size profit are they looking to make?
That's brilliant. All right, we've got a couple more minutes. One of the things I wanted to talk about is PAYG variation. So, Patrick, with increasing interest rates, maybe the property's now heading towards initially a negative cash flow position before they get the tax back at the end of the year. So whether an investor has one property or maybe a portfolio of 5, interest rates have gone up, holding costs have gone up. If cash flow is getting a little bit tight, do they have a strategy around this PAYG thing? Can you explain it, and how would that help a client?
Sure. So PAYG tax variation is a very common strategy, and the ATO is very sort of that they agree for that to happen. What it is you're pretty much doing a mini tax return at the start of the financial year, and we do a lot of those. So we actually work out what the future refund is for the client. We average that over a weekly or fortnightly or monthly period, depending on what your pay frequency is. And we prepare a schedule that you then lodge with the ATO, and we lodge that on behalf of all of our clients. So you're pretty much going to the ATO and saying, well, I'm expecting a $20,000 tax refund for next year, but instead of waiting for post 30 June 2024, I would like to have that in my hands before the end of the financial year. So the ATO then agrees and goes back to your employer and recommends a new rate of withholding tax for you. So your employer is bound by that recommendation from the ATO. And what it does is your employer then reduces the amount of tax that they withhold from your weekly, fortnightly, monthly pay packet, which means that you get more money in your hands every week by the strength of this PAYG tax variation recommendation from the ATO.
Right, fantastic. We've got one question. I know we've just gone a minute over, guys, so please be patient. We've got a question come through from Stanley. Can we claim depreciation on an older property? How old can we claim depreciation? So we've got a property 30, 20, 10 years old. Can we claim depreciation still, Patrick? Absolutely.
Established properties, you can still do a depreciation report on them. DebtPro and BMT would do that for you. The only thing with an established property is that your deductions won't be as much as the new property. But yes, you can still have an older property, a depreciation report done for them. I think if the property is older than 30 years, then it's probably not worth doing a depreciation report for those properties, because most of the life of the asset has actually passed.
Yeah, no, that's fantastic. Thank you very much, Patrick. All right, I think that is our last slide. Are there any other questions from the panel? What we will do is I will send a recording of this webinar, so you can go back and listen to, maybe go back and re-listen to any sections. I will also be sharing the contact details of Patrick and of Jamie, so I'll be giving you their email address and landline number. If you wanted to follow up with them directly, please go to them directly. And I think we've got one more question coming. See, no, it's just a thank you coming in from Stanley thank you to Patrick for answering this question. But yeah, two very other knowledgeable speakers today. I really thank Jamie and Patrick for their time. It's important, the price of property, the cost of buying and selling properties, buying the stamp duty, selling the capital gains if it's an investment property, and the selling agent fees. It's expensive to buy properties in Australia, and it's expensive to sell them. So the buy and hold strategy is good, but you've got to get it right then, because if you don't get it right, the leveraging is good if you get it right. If you get it wrong, the leveraging can work very badly against you too. So it's about if property is done well is fantastic, and it's about, we've heard everyone talking about a team. You need to have these experts. I can advise on property, Jamie can advise on property management and strata, and Patrick can advise on accounting, but we stay in our lanes, and that's what we do. So Patrick and Jamie, thank you very much for your time and input today. Greatly appreciated, and we look forward to chatting to getting you on again next year. Thanks, guys. Thanks for giving up your time on a Saturday. I hope even if there's one thing you picked up today, that it's made you worthwhile. As we promised, there's been no sales. We haven't sold you anything. It's been strictly education. Have a wonderful weekend, and thanks very much. And from the presenters, thank you.
Thank you, guys.
Thank you.